Ladies, we're going to get started. I just want to first and foremost thank everybody who's here in person, everybody who's joined virtually. This is a first. So my name is Chelsea Garber, CEO of Ascend Equity, ROI by Design, and I have been incredibly passionate about building wealth, not only for myself, but for others. And along my wealth building journey, which included acquiring now roughly $30 million of commercial real estate, I felt that there was never really a place particularly for women to talk about money. So ConnectHER came to life out of my passion for building wealth, but also sharing just all of the knowledge and resources that I've learned over the years with other busy, successful, not just women, but men as well. And so it's part of my mission, and it's something I'm really excited about. And I've had the opportunity to get to work with Kaaren and uDirect, and it's just been a fabulous experience. And so, Kaaren, thank you so much for being here today. For those of you who don't know Kaaren Hall, she's the CEO of uDirect IRA Services. And we're going to talk tonight all about the ins and outs of using retirement funds to invest passively. And there's many things you can invest in. She has over 20 years of experience and has guided thousands of Americans in starting and diversifying their portfolio using self-directed IRAs. And she's also managing a staggering $1+ billion, yes, I said billion, in assets. So she's just a powerhouse and brings a wealth of knowledge in mortgage banking, real estate, property management. And she's going to put on a fabulous presentation tonight, and we're going to have Q&A at the end. So if you have any questions, you can drop them in the chat, save them for the end. Either or is great. But without further ado, Kaaren, would you like to introduce yourself?
I would love to. Thanks, Chelsea. I really appreciate the opportunity to speak to your group tonight. This is awesome. I do have a PowerPoint presentation, so I'll go ahead and share screen if that's good.
Yep.
Let's do that. Oh, it's disabled. So let's.
Oh, here you go. Hold, please.
Self-directed IRAs can be used in a lot of ways. One is to build your own retirement, but the other one is to raise capital for your deals and help other people, improve their retirement savings. So we're going to touch on that tonight. Let's see. Show all windows. So let's start from the beginning. There we go. All right. So this is a presentation I did at Bigger Pockets in October. And so I'll share this with you. And like I say, self-directed IRAs are for your own retirement, but they're also to help you, and they can also help you raise funds for your deals. So there we go. So a little bit about my background. Chelsea mentioned a little bit about it, but I've been, my previous life, property manager. I've been a realtor. I've had real estate licenses in 3 states. I did mortgage loan servicing and origination for many years. Also, I'm a real estate investor, and had a life and health license too. So, all this mix of real estate and finance, and also 17 years in the self-directed IRA industry. I sit on the board of directors for the Retirement Industry Trust Association. And I have a couple of certifications: self-directed IRA Services Professional and Certified IRA Services Professional. So that's my credentials. Plus, as you say, 15 years as CEO of uDirect IRA Services. I've helped a lot of people. So hopefully I can help everybody here and answer all your questions tonight. But before all that, my career was I was a radio announcer. That was my first career. And I was in Seattle and in Phoenix, and where was I? At Los Angeles and Hollywood and all over the place. But that was a lot of fun. So all these skills that I've had, radio helps me do podcasts, and all the other things come together perfectly in the self-directed IRA space, because there are just so many different kind of assets that fit into the self-directed IRA space. But when you're talking about maybe raising capital for your own deals, here's something to keep in mind. There's around $41 trillion in retirement. So it's not all in IRAs. It's about 17 million or trillion in retirement money, IRA money. But you can tap into this pool of funds for your deal. And so the way you do that is you just ask a potential investor, hey, do you have an IRA, or do you have a 401k with a previous employer, or maybe a 457 or 403B. Because if they say yes, they probably don't even know that they can take that money and instead of putting it back in the stock market, they can invest in deals like the ones you have. And you can invest outside of Wall Street using this tool. So by the time we're done, you're going to know all about it. So if you are raising capital, the problem that you solve is helping other people to build their retirements, right? So, you can make it a home run, your next project for not just for yourself and the neighborhood, but also for the investor. Isn't that great? Well, we can all grow our retirement together. I love it. It's kind of like, it can be like an all-win situation, which is fabulous. You don't get that very much. Now, if you haven't heard about self-directed IRAs, I'm really actually not surprised. I've been doing this 17 years and a lot of people still haven't heard about it. And a lot of people are coming up and newly, emerging into wondering, hey, I need to think about retirement. What should I do? So a lot of attorneys and CPAs aren't even knowledgeable. But these rules have been around since 1975. So before, you're probably even born. And so when IRAs were created, it was through the ERISA Act, the Employment Retirement Income Security Act. They created IRAs. And so at that time, you could self-direct it. Self-direct isn't a separate IRA. It's just sort of a jargon name that came up because financial advisors have certain SEC licenses. And so they're not allowed to recommend or advise you in investing in alternative assets. So the alternative asset space, it's called the self-directed IRA, where it's not stocks, bonds, and mutual funds. It's non-correlated. And that's what goes in this bucket. But an IRA is an IRA. What makes it self-directed is just the assets that you put in. So, like I mentioned, the difference really is a typical IRA. You might have with, Charles Schwab or TD Ameritrade or something. That's going to be invested in mutual funds, CDs, the stock market, index funds, something like that. But with a self-directed IRA, it's single family homes, it's private equity, it's, raw land, it's precious metals, even cryptocurrency, performing and non-performing debt. And your IRA can even be the bank and lend money from your IRA to others as long as you don't commit a prohibited transaction. Okay, those are the rules. So we'll get to the rules here. When the IRS created these IRAs, they said, hey, an IRA can invest in anything except life insurance contracts and collectibles. Life insurance contracts, collectibles, that's a short list. So no fine wine collection in your IRA, no coin collection in your IRA. You can invest in precious metals as long as they have a very high level of purity, but no collectibles in an IRA. So that's pretty simple. The rest of the rules have to do with prohibited transactions and what you really can't do. So if you're a rule book person, you want to look it up, you can go to Internal Revenue Code IRC 4975. You want to jot that down. You can also read about the rules on the IRS's website. It's irs.gov. And they have these publications, super easy to read, very informative. Pub 590 talks about the traditional and the Roth IRA. And if you read this, Pub 590B goes into some details also about these prohibited transactions. So you don't borrow money from an IRA to use personally. And you don't sell anything you already own to your IRA. It's not security for a loan. And you don't use your self-directed IRA or any IRA to buy assets for future personal use, technically. Okay, so we'll talk about this, but those are the rules. And really this whole thing, the self-directed game to win it, it's, keep away there, keep away from prohibited transactions. Okay, so prohibited, right? It doesn't sound that bad, does it? It's like, yeah, it's prohibited. Here's what happens. If your IRA were to commit a prohibited transaction, it would be the tax protected bubble that your IRA has would burst, and that money would become taxable to you with penalties and taxes. So I'll let you know that I've only seen half a dozen of these in my long career, so it's not likely you'll commit one. We offer a 20-minute free consultation. We also review your documents and take a look at everything. We're scanning for prohibited transactions. Not many that we can see get through. But just so you know, the onus to not commit a prohibited transaction is on the accountant. 100% your responsibility not to do this, but we want to educate you so you understand what the rules are and how to avoid them. So here's some of the rules. Neither you nor any disqualified person can benefit from the IRA. So disqualified people It's up and down your family tree, like your parents and grandparents, you and your spouse, and your children and your grandchildren disqualified, plus a 50-50 business partner or anybody who has a fiduciary duty to the transaction, like maybe a realtor or CPA or an attorney, right? So you're not allowed to have personal benefit. So your IRA does not, for example, make a loan to yourself. Your IRA also would not make a loan to maybe your kids to go to school, because your kids are disallowed. So making a loan to them would benefit a disqualified person. That would be a prohibited transaction. Okay. You also don't buy, sell, or exchange assets between the IRA and those disqualified people. So your IRA doesn't buy a house from your parents. Your IRA doesn't sell a house to your kids. You don't, that's how that works. That's how that works. Disqualified to the IRA. Don't buy, sell, or exchange. But the third one here is really, I think, where we have the most friction. And that is to say that one of these disallowed people, up and down the family tree, that brothers and sisters are okay, right? Nieces and nephews, they're fine. But the disallowed people can't provide goods, services, or facilities to the plan. So a lot of times when I go out speaking, I'll speak to people who are raising capital, and maybe they're a general partner, a GP, and it's their fund. They cannot use their own IRA and their own fund because they're providing services to the plan through their efforts and their labor, and they're probably also getting paid. And that would go up to number one, which if you are getting paid for the, based on the proceeds of your IRA-owned asset, you're receiving personal benefit. So these are some things that can be complex, and this is why we always want to talk to you before you invest, so that we just make sure that you're steering clear of this. But just so that you know, there are prohibited transactions. I like this quote: retirement can be a reward for saving and investing, or a punishment for not doing so. So I imagine that all of you are here, on a Wednesday night. You're all very gung-ho and the top 1% where you really want to make sure that you are doing it right. And so I don't think that you have to worry about this. But just remember, it's always a good thing to, like one thing after you listen to this, you always want to have a takeaway, something you can do, like an action item. And that action item could even be make a contribution to your current retirement. Pay yourself instead of the IRS, right? Before you file your taxes. So I mentioned we're going to transition here to kind of like how to invest and what investing looks like with an IRA. And I did mention that my background included mortgage loan servicing and origination. So when I first got into self-directed IRAs, and I found out when I found out an institution would make a loan to an IRA account, I was really surprised. But this is true. So an IRA can take a loan. It's called a non-recourse loan. All right. So the IRA is not just a down payment on a property. So, your IRA cannot take out a Fannie, Freddie, conventional conforming FHA, VA loan. Those loans are not okay. Only a non-recourse loan. So if the IRA were to default, the lender can only come against the subject property, not against you personally or the IRA owner personally, and not against any other assets that happen to be in that account. So that's great. So a non-recourse loan, they're available. Not a big list of non-recourse lenders to choose from. So if you would like a list, you can just email me, and maybe Chelsea, you want to throw this in the chat. It's or whomever, but the email address is info@udirectira.com, and that's how you get a hold of us, and we'll send you the list of non-recourse lenders. So again, not a lot of lenders to choose from, and usually these lenders require more skin in the game than would be the case if you were purchasing a personal residence or a vacation home or a rental property personal. Maybe 40, 50, 60% down. Each lender has their own criteria. And of course, underwriting guidelines, it's based on risk. And so you need to talk to the lender to figure it out. But you can get this loan, and it can help you to invest. Now, you cannot personally guarantee the loan because you are disqualified from the IRA, and you would be offering, you'd be personally benefiting the IRA. It's not. So now, this is something super important to know as a self-directed IRA investor or potential investor, is that, yes, IRAs are tax-free, like a Roth is tax-free. A traditional, a SEP, simple is tax-deferred. That's true. But there's a different kind of tax, not income tax, but UBIT and UDFI taxes that are just specifically toward what I would call them like like nonprofit organizations, right? Like an IRA. So if your IRA is to borrow money and say you find a property, it's $100,000. And so your IRA purchases this property using $70,000 from your IRA, but borrows $30,000. So in this case, 30% is borrowed. And so then here comes your rent check for $1,000. Well, your IRA earned $700 of that because you saved, but your IRA also earned $300 of it because you borrowed. So that $300, that pro rata share, based on what you borrowed, that 30% will be subject to this tax. So you just want to know that UBIT is when your IRA invests in an active business. If you do owe it, it's not the end of the world. Your CPA or your tax person can fill out the Form 990T for you. They can take deductions if there are any, that can happen. But if you want to read about it, go to the IRS's website and look up Hub 598. And you'll learn all about the 990T and what these taxes are and how they work. But just know that they exist and you could run into them. Also into syndication, if you're investing like say a Reg D offering and that asset sponsor is also taking on leverage along with bringing in equity investors. The money that your IRA earns due to leverage in that syndication will also throw off the ABFI tax. So good to know. Now, when your IRA invests, whenever there are expenses, 100% of the expenses related to the asset, have to be paid for from the IRA. You can pay the account fees out of your pocket, that's okay. But say your IRA owns that house and it needs a new roof. What are you going to do? What are you going to do if your IRA doesn't have enough money for the shortfall? What if you invested in private equity, like I was mentioning, like a Reg D offering, a syndication, and there's a capital call? What if you have to come up with the money to meet a capital call, but your IRA has run out of money? So here are a few things you can do. You could make a contribution, and that is going to depend upon your age, your account type, and your income, how much you can contribute. You can liquidate other assets within the IRA, sell them, and bring in those proceeds and make up the shortfall. You could do a transfer of another retirement account. So if it's IRA to IRA, just fill out a transfer form, move the money, it happens. It could take a week, maybe, to get the money over. You could bring on a partner, a debt partner, get a loan, or just if your IRA can't pay the expenses, then what you can do is you can just sell the asset and then move on to something else. And a lot of times when people are approaching their RMD age, required minimum distribution age, we'll have a talk with them about the asset they're investing in, because sometimes assets do have a lot of expenses, and once you reach a certain age, you may not be working anymore and may not be able to make a contribution. So just to say, there are a lot of factors. So when you buy real estate with an IRA, there are steps, and really these are the same steps for investing in any other asset class. But it seems, except for like crypto and precious metals, almost every other asset is tied to real estate, that falls within the alternative asset category. So if you're going to buy brick and mortar, we'll talk about this, but again, this is the same process. First, you get the account open and then shop for whatever asset you want to acquire, because you need to have an account open in order to invest. So do that first, get the account open, get it funded, shop for your property or your deal. Remember, the IRA is the buyer. So it's not you personally purchasing the asset, it's titled in the name of the IRA. So you give us the documentation, a direction of investment form, we review those documents. We're not saying it's a good or bad asset. What we're going to do is make sure it's titled correctly, that you're actually going to receive an asset in exchange for the money that you're sending out. But once we've done all that and taken a look at it, we'll wire, in the case of real estate, wire money to closing. You fund, you record, you get your keys, and your tenants move in, and now all rents are going to be made payable to your IRA. Pretty straightforward. Same thing if your IRA invests in a syndication, the asset sponsor will send the proceeds to your IRA with the check made payable to the IRA. Now, I'll tell you what, if you're investing with an IRA and you ever get a check made to yourself personally, return it immediately, because that would be a prohibited transaction. You can't cash those checks. Okay. So if we have questions, I'll take them, but I'll just keep going on here and give you more to think about. This is an exception to the rule. Now, I did mention, oops, I left that on. you're not allowed to invest with disallowed people, right? But here's the exception. You can do this, and here's how it works. Say in this case, a father and a son are going to buy a house together. Dad has cash, son has a traditional IRA. So they can do this. Son 50% owner, dad in this case 50% owner, whatever their pro rata split is. And it reads custodian for the benefit of the son's IRA 50%, dad 50%, tenants. That's how that works. And yes, they're disqualified to each other, but it's a loophole. If before the deal, neither one of them had any ownership interest in that asset. And because it's a new deal, they can do this. And as long as they record on title concurrently, it's a loophole, and you can do this. Now, after the deal, that's when that disqualified person rule comes into effect. They're never going to sell their part to each other. Neither one of them can ever have personal use of the property. It's got to be a rental property. And there you go. So they also have to pay the bills, don't they? So when that happens, dad will pay his pro rata share from his checking account, and the son will have his IRA pay its share. And then there you go. So you would, anytime you partner with an IRA, then everything is split like this. And that's how it works. So you can invest with disallowed people as long as you do so concurrently. Most important. But there's another tool that your IRA can use. Maybe you've heard of this. It's called a checkbook IRA. It's also called an IRA-owned LLC, which is, I think, a more correct title because it's more descriptive. But here's how it works. So you have a self-directed IRA here. Okay, it's got money. You have a third party create a special purpose LLC, because remember, you can't use an LLC you already own because your IRA can't invest in an asset you already own. So there's money in the IRA. Here's an LLC with a checking account. You give us a direction letter. You give us your LLC's docs. And then you say, hey, send money to my LLC's checking account. So the money goes from the IRA to the LLC's checking account. Now you get check writing authority. So it's the IRA that owns the LLC. IRA is the umbrella. The LLC is an asset of the IRA, like this. So that's how it works. Now you can, you can go ahead and purchase any asset as long as it's, allowable. And you have to steer clear of prohibited transactions. Well, I say with great power comes great responsibility, right? To quote Spider-Man there. When you've got a checkbook IRA, you don't have us looking at your deals, and you're making these deals, and you could commit a prohibited transaction easily. So again, before you do this, talk to us, and we'll walk you through the process. But it's like maybe, for example, if you want to buy properties from an auction and you need to have the money right now, this could make sense. Maybe if you are investing in tax liens, where you buy the right to collect property tax, your IRA could do that. You'll have a lot of little transactions with that. So it might benefit you to have a checkbook IRA because of all the tiny transactions. You don't want to get feed to death there. So those are some reasons why it can be very, very helpful. Okay, so we call it a self-directed IRA, but it's all this. It's all this. It's the traditional, the Roth, SEP, simple, spousal, inherited IRAs, solo 401k, which is a really cool plan for people who are self-employed, have no full-time employees in any of the companies they own, has a lot of bells and whistles, like a super high contribution limit. It's a lesser of 25% of your income up to $69,000 a year. With the solo K, if husband and wife are both principals of a company and they don't have full-time employees, each husband and wife can each contribute up to $69,000 and stick all that money away tax deferred. Pretty cool. So it's a great way to save for the future. Also, we offer the self-directed HSA. I'll say. So, self-directed, it sounds pretty great because you can use this retirement money to invest in assets that you know best. You might not know how to, calculate a PE ratio or something like that, but you probably know how to buy a house. You probably know all about houses or alternative assets. So it lets you invest in what you know best. So if you've got money with your current employer, or if your investor wants to invest with you using an IRA and their money is with the company, you got to wait. You got to wait until you leave the service of the company. And so especially if you have a 403B or a 457, but with a 401k, you might be able to get before that money. What you do is you contact the plan administrator and you say, hey, I've got a 401k with the company. do you have a provision for an in-service transfer? And there are conditions, and maybe the employer is elected to offer an in-service transfer while you're still working there to be able to move the money. So you just ask the plan administrator and they'll tell you. So we were talking a little while ago, what do you do about like if there are expenses of the IRA that you don't have enough money? Well, let's talk about what if there are actually losses? What if you invest in an asset that becomes, we call them toxic assets. We say that you invested with a bad actor, somebody who maybe stole your money, or maybe there was a hurricane or some act of God or something, and there was just a loss. So the first step is to do your due diligence ahead of time, to do as much work as you can to prevent getting into a bad deal. And there are lots of ways to do due diligence. So I'll just touch on a couple of them. One way is if you're investing in a syndication or a large note, or anything that has to be registered with the SEC, you can go to FINRA's website, FINRA. FINRA, it's a law enforcement arm of the Securities and Exchange Commission, and go to broker check. Just Google broker check and look up those people. And I've done this too, with looking at asset sponsors and finding out, hey, have they ever had a complaint? This is a good thing to do up front. Also, Google the person. If you're investing with someone, Google their name and the word fraud after. Google their name and the word, I don't know, lawsuit or something, to see, have they had any trouble? Have they, we actually had a woman who invested a lot of money in a real estate deal, but before, we ended up not funding it because we could see that the people she was investing in, or she was investing with them, one of them had actually been incarcerated, he was jailed by the SEC for stealing millions of dollars from investors. And she did not do her due diligence, and she almost, we don't always catch it, but we did this time, and she did not lose her $500,000. That was a really nutty situation, but we were able to prevent that. So do your due diligence. Make sure you're working with honorable people. If it's real estate, get a preliminary tax report. If you're investing with someone, talk to other people who've invested with you. Do your due diligence here, because losses in an IRA are not written off. You don't get to take a deduction for them, and it's just gone. And it's tough to replace those losses too, because contribution limits are capped. So you may have lost more money than you could put back in your IRA in 1 year, maybe even 10 years, depending on the size of the loss. So the way to invest well with a self-directed IRA is to do the due diligence. And if you are investing with an asset sponsor, one of the things to ask them up front, this is something I've learned over the years, ask them, hey, I want a provision that allows me to look at your audited financials as you go forward. Now, they may not have audited financials, maybe it's just financials. But if they are in fact audited, pick up the phone, look at the financials, but pick up the phone and call the company that audited those financials and ask them, hey, did you audit these financials? Because a fraudster is going to, be a fraudster, and maybe they're also, being fraudulent about that. So you want to definitely check that. A lot of times Ponzi schemes happen after you get into a deal. So what I would do is find an asset sponsor who's got a good track record and a lot of happy investors. Okay, so how do you self-direct? It's really easy. After all these rules I've told you, that we will help you steer clear. We'll talk to you about them and discuss them. But it's easy as 1, 2, 3. Open an account, super easy. Fund the account either by transferring an IRA, contributing money to the account from your own checking account, or rolling over a previous employer. So it's open, it's funded. Now you invest. You find your deal, you give us the documentation, like the contract, along with a direction of investment form, which is giving us permission to send them, your permission to send the money. To open, fund, invest, your deal funds, and now the proceeds go back in the IRA to own that asset. And now you've self-directed. Now you're building your future, and it compounds faster. That's what's so great about self-directed IRAs. This money is compounding faster because it's not being diminished by tax, right? You don't pay income tax on this until way in the future when you need the money and you take it out in retirement. So there you go, open, fund, invest. There's a QR code if you'd like to learn more. There is my headshot, what I look like after 2 hours of hair and makeup. And how to get a hold of me. info@udirectira.com.
Thank you so much, Kaaren. I mean, that was a lot to take in. Probably if that's your first time hearing it.
Yeah.
I learned some new things this evening. let's open up the stage. I know some of the ladies in person might have some questions here that they were wanting to ask, and that might answer some others who are here on Zoom. I think Valerie.
Question,
Yeah.
So, if you, similar to saying, like, you lose the money if somebody defaults or whatnot, but if you go through the transaction, the property sold, 5 years down the road, and then can you move that money back to, another 401k?
Yes.
That there until you retire and you, I mean, is basically would I leave the money there until I retire and then?
Okay, so you're asking if the money that you net, the proceeds from your investment goes back into the self-directed IRA. You're saying should it sit there or go then back into the original IRA? That's
Yes.
correct.
Well, you can always transfer your money. You can always do that. So, but what you may want to do is invest in another deal, and let your IRA keep growing with alternative assets. Or you can move it back into the stock market, whichever you want. But yes, it's completely portable.
And to add on to that, so if, let's say you put the money, let's say we just have it with uDirect, you're the custodian of the funds. What is the return on like a percentage if the money's just sitting in the account waiting for the next deal? Like, or is it more advantageous to put it back into the original retirement fund? And how much time does it take to go back and forth?
Right. Well, and those are a lot of questions. I mean, I think what you need to do is first look at your overall investing strategy and what are your plans. And if you want to continue to invest in alternative assets, leave it in the IRA. uDirect does pay a little bit of interest on the money. Most self-directed IRA companies don't. You pay 0.1% on the money that sits there. And yeah, it's not a lot of money. It's not making you rich, but it's also not at risk in the market. You're not going to, it's not, the value isn't going to drop. It's going to be there. And also, if you have a shortfall, like I mentioned, you could have, well, anyway, but you can always take it out. You can always transfer it to any other account. You can always do a complete or partial transfer of the money out of the self-directed IRA into a market-based kind of retirement.
Mm-hmm.
Right, without tax-free until you decide to use it as you retire.
Correct.
Yeah, when you transfer it, there's no tax. It's not taxable to move the money from account to account. That is not a taxable.
I'm Chelsea's mom, and I'm retired.
It's hard to hear, by the way.
Oh, yeah. Here, come over here and ask the question or speak very loudly.
So I'm retired and, of course, Chelsea's got all these things that I'm interested in investing in. So right now I can take money out of my IRA and turn it, let's say, if I want to take 100,000 out of my IRA now, I can put it into a self-directed.
Yes.
Okay.
Yes.
But because she's my mother, she couldn't invest in one of my deals, correct? That is part of one of the prohibited.
That's exactly right.
Yeah, that's correct, because you're a direct lineage family.
Okay, well, I better find somebody else.
Yeah. I'll steer you to some people I know.
Are there guidelines that come over there for investing in a business that you work for? So I work in private equity and I do typically invest in, each.
Can you hear Kaaren?
No.
Yeah, sorry.
Okay, are there guidelines around investing in businesses that one works in or for? So I work in private equity and I typically do participate when we're going through, various bouts of fundraising, but I have never thought about investing through my IRA or through a retirement vehicle. Is there any kind of guidelines around being able to invest in a company that I'm working for? I'm not making investment decisions. I work in HR.
Okay.
So I'm just wondering what kind of limitations might exist.
Yeah, there's something called the 5% rule. If your investment is less than 5% of the total, the total pie, you should be okay.
Yeah.
Check.
Yeah, we're raising, $600, $700, $800 million in
So
these.
yeah, maybe. Yeah, you should be okay.
Okay.
It's if you're getting paid, like a direct correlation between someone investing and your paycheck, that would not be good. Or which is to say, like if you're a salesperson and you're getting a commission, or if you're a C-suite making the decisions about which asset to find. But if you're in HR, you should be fine.
Okay, wonderful. Thank you so much.
Andrea, who's here with us on Zoom, I think she has a question. So Andrea, hold on, let me, I don't know if you're able to.
I see that here. Do you have any
Drop a question.
experience working with accounts that are shielding UBIT through the use of a blocker corporation? Oh my gosh. Oh gosh. You want to go, advanced class here. I would talk to John Heyer about that, and you can use blocker corporations, but I mean, I have no experience with this at all. How about that? 17 years in the business, but you can do it. But do you want to do it? And I would just, John Heyer is a great attorney. He was in Puerto Rico, and he will talk about this all day long. He's got some really good reels out. So find him on Instagram, and he has reels all about blocker corporations. Also, Amanda Hahn, the CPA, Amanda, she's big in the Bigger Pockets community. She also talks about using blocker corporations. And she says, that's okay, I've got an investment, I'm working through this issue with your lawyer. So that's perfect, you're getting legal advice. I mean, can you do it? Yes, but I mean, if you're working with a lawyer, that's perfect.
I have a question, and thank you, Andrea. Andrea is definitely a sophisticated investor who's done multiple deals of her own and syndications. Oh, wait, I'll let Melanie go. So Melanie asks, oops, sorry. Yeah, understanding that if I invested in a property with my parents, I can't buy them out. What would happen if they passed away, and could they sell their share to someone else? That's good.
We do have the advanced class here tonight, don't we? So if your parents passed away, then their IRA would go to their beneficiaries. And if you're a beneficiary, then that property would go to you. And if they passed away, they're probably not selling their share, but they could also, I mean, obviously, but while they're living, they could sell their share to someone else. Yes, absolutely. As long as it wasn't a disallowed party.
Jen here in person has a question.
I do.
Okay.
So if you own rental property, in your IRA, what sort of liability exposure does that open up to the other assets in that IRA or to you personally, if at all?
Okay, so if you are investing your self-directed IRA in a piece of property, what are your liabilities sort of, and how can you shield yourself from and protect yourself? So yes, if you have an IRA and maybe there is like a prohibited transaction, it would affect all the assets in the account, not just the one where there's a prohibited transaction, for example. If you have, sometimes people will use the IRA owned LLC to shield and to discourage lawsuits. So if there was a lawsuit against your IRA, you've got an asset and it's an IRA owned LLC, you may have some asset protection, but then understand, I mean, I'm not a lawyer, I'm not giving legal advice, but an LLC is also a little bubble. And it seems that when you take a disbursement, that's when you probably have to pay on any judgment. So it's something to go into deeply, but if you get sued, are your IRA is protected. Now, there's another way to look at that from a different angle, and that is to say that if the money in your IRA came from a 401k or an ERISA plan, like an employer plan, it could have what's called, I'm going deep in the weeds here, but it could have an anti-alienation provision, which is to say that it would be protected from predators. That's possible. So you need to look up the state you live in and Google for your state to say, is my IRA protected from predators? So that's another thing to find out. In California, not so much, but where I live, but it's different all the time.
Yeah. Looks like Melanie had a follow-up about her first question is what happens if somebody passed away and then could they sell their share? And the follow-up was, could I then buy out the share from the second purchaser?
I see. Yeah. Could you? You could. Would it be prohibited? Possible.
Possibly.
That's kind of a gray, that's a real gray area. what I would do is get an attorney opinion letter before moving forward with that. So that you move ahead with having an attorney giving you their blessing. It's a very gray area because your parents are disallowed. And even if your parents sold the property to someone else, it's, you have an interest in the property. And it's just a gray area. I would get an attorney opinion letter just to be super safe.
What is the process, timeline wise from start to finish? Let's say, we have some women in the room, maybe some people on the Zoom here that are actively looking to invest in one of these alternative assets. And they, obviously first is have potentially an introductory call with you or another self-directed IRA company, but walk us through what the steps look like in the timeline. I know.
Yeah, I'd be happy to. I mean, I think that the first step is that, I'll stop sharing my screen there. The first step is to open an account. And that is super easy. Opening an account, it just doesn't take very long. I'll throw up here in the chat. This is our, let's see, I can go to hosts and panelists. And if you'd like to share this link, you can. That is, if you go to that link, you can open an account. And you just fill out a form. It's a digital form. And then you've got an account. And that is the first step. It takes, 10 minutes maybe to go through that form. Then now you've got an account. The second part is to fund the account. And so at the same time that you're creating the account, you can put in your information for a current IRA and saying how much you want to transfer from that IRA. So you can begin the transfer process, the funding process, as you're also opening the IRA. But once we get that transfer form complete, we'll send it off to your custodian and they'll send the money back. If you're in a hurry, ask for a wire. Wires are great, they're fast. We only charge $15 for a wire. Our fees are really low, by the way. $15 for a wire. And then, so I think give it a week on the outside to get that money from an IRA. If it's an employer plan, it's going to take about 10 days. And then when we get the check, there's a 10-day hold on. So it's a check, it definitely takes longer. And a previous employer plan is going to give you a check and it will take longer for the process. When you have make your contribution personally, you can just make it right on our platform and just ACH the money in. That happens straight away.
It sounds like this is up to a couple of weeks. Would there be some cases with certain custodians that would be longer? Like companies that are to,
Yeah, I know. I hear what you're saying. So opening an account takes a day. Getting it funded takes 2 weeks. Well, while those 2 weeks are happening, while we're waiting for the money to come over, that's when you're giving us the documentation so we can review it and get it all queued up. So once the money hits, it's going out. Probably the next day, so it's not a check, and then it's pretty quick. But yes, there are some companies that will take 3 weeks to fund a deal, and some companies that aren't in a hurry. But with my residential real estate background, residential real estate, if it wasn't yesterday, it wasn't fast enough. And I had enough years on that I'm completely indoctrinated in the do it now kind of mindset. So I'd say a week is average, but the fastest anyone has ever done a self-directed IRA investment from start to finish is 4 days. Okay, that's the fastest.
Yeah, that would be absolute best case scenario, of course. Yeah. Anybody else have any questions here? I know this was.
So most custodian accounts would be able to fire. It's just the check is mailed if it's a former employer holding the account.
She's talking about former employer checks. What was that question?
Yeah, so if a former employer is holding the funds and they're sending a check, it sounds like that is, first you have to get the check and then it takes 10 days for the check to clear. So
Yes.
that would be.
And they're mailing the check. So yeah, it's long. It could take a couple of weeks.
But a financial custodian account typically would be able to wire it.
Yeah, a financial custodian account would be able to wire the money, which is ideally what you want.
Correct. Directly to your account, yes.
Okay,
There's a third way, if you want to hear about this. You could take what's called an indirect rollover. This is also advanced cost, but I think all you women here are advanced, so we'll go with this. But the 60-day rollover is to take the money personally. And you can do that once every 12 months. Take the money out as a withdrawal. And then as long as you put it into another retirement account within 60 days, it's not taxable to you. And you're allowed to do that. It covers all your retirement accounts. So for all your retirement accounts, you can do that once every 12 months. But if you're in a real blinding hurry, take a withdrawal to, have the bank wire the money to your personal account today. And then you get the money in your personal account, wire it to your IRA tomorrow. That's we call it an indirect rollover. It's a 60-day rollover, sometimes it's called. And then that's a really quick way of getting the money in if you're just really in a super.
This might not be a question in your wheelhouse, but what is the typical return when you have your money in an IRA? Not obviously with you, but
Yeah.
What's the average?
Yeah, and really not my wheelhouse. And it all depends upon what you're investing in. We all have our risk tolerance and.
No, sorry, I didn't mean like once you put it into investment. I mean, what is a typical IRA return like as from a previous employer? Like let's just say you have a Northwest Mutual. Like, are you making 4%, 5%? Like, is there it just
No,
depends.
it's not typical. It's individual because again, like I have accounts with Northwestern Mutual and it's based on my risk tolerance. So maybe if you're 20 years old, maybe you've got a high risk tolerance and you're investing in assets that maybe you're earning higher returns because you're taking more risk and you're winning. But maybe as you get closer and closer to retirement, maybe you're taking less risk and earning a short, smaller return. So I wouldn't say there's an average return.
Where does she see like, on people who use their IRA money or something with IRA money, what investments is she seeing as like, good return?
Oh, good question. Kelly asked, where are you seeing the best returns through the self-directed IRAs? Obviously, most of it is going into different forms of real estate, whether it's, invest single family home, multifamily, debt funds. But there's
Yeah.
like,
Or what they want.
I'm not sure. Yeah.
She mentioned it earlier.
Yeah, there's a whole list of things. I have it recorded, don't worry. But yeah, so is there somewhere like that you're seeing, Kaaren, from your experience that are providing more lucrative returns, but maybe it's riskier or maybe it's not? Like where
Yeah,
does
the
it all
different asset classes. I guess you. So I mean, if you have a massive risk tolerance and you want to invest in crypto, that's going. It's crypto spring right now. It's doing pretty well. But that's the Wild West and it's just fraught with risk. So that's pretty good returns though. I think people have tripled their money or more, more than that, but it's a risk, right? Do you want to throw everything in there? Probably not. But I think real estate time and time again has a really great return. I spoke to somebody earlier today who had a real estate fund that was paying out 30% returns. But you can't guarantee a return. Is somebody who is in that situation, they don't guarantee returns or even usually talk about them. Yeah, that wouldn't be too bad. But what you need to do is do your homework, find out, talk to other people, attend events like this where you can talk to people that are offering investments and what are their investments about. That's the way to do it. I mean, real estate often has very high returns, but it also, you can also lose money. Look at during the Great Recession, no one expected to lose money at that time on real estate. Everybody was just so happy with their real estate, going gangbusters, and then the floor fell out. Always risk in investing, always. You can also be the bank and lend your own money and decide the interest rate as long as it's not illegal. It's called usury, and so you can lend your own money to people as long as they pay you back. But one asset that I personally like is secured debt on real estate, because if the borrower pays you back, you get your return. If they don't pay you back, well, you've got a lien against the property and you get the property. You get the right to sell it. So that might be something to look at. But again, you have to decide what's right for you. And we're not investment advisors here at uDirect. We don't tell you what to do as far as investing is concerned. But those are some of the things that our counselors do.
Yeah, I think the key is education and taking action and diversification. There's a lot of different.
Another thing I like personally, but not just because of the returns, but I've been investing in precious metal silver, like the silver eagles, and you can do that with a self-directed IRA. You can do it personally, but I just like it. It's a hard asset, and there you go. It's also a U.S. minted coin, kind of a thing. So a lot of different asset classes. Even raw land is cool. If you invest in raw land, You can rent it out to people to graze their cattle, rent it out to people to put windmills on or something. So a lot of fascinating aspects.
Yeah, thanks for sharing that. Anything else? Everybody ready to invest in their? No, this has been awesome, Kaaren. I know it's, from my experiences, it's just, you continue to learn and educate, and what you feel comfortable with is usually what you invest in, and it just doesn't happen overnight. I've spent years doing this myself, and like I said, it's just, taking action, and most people have some sort of a retirement fund, and these opportunities are kind of like what I say is like adding rocket fuel to the spaceship. So just, we're taking our money off of Wall Street, taking control of our finances, and building wealth is a team sport. And that's why we're all here having these conversations together, learning from each other's experience and expertise. So we really appreciate you for joining. This has been recorded. It's going to go out to probably over 400 people. So I'm sure there'll be lots of follow-up questions and emails. And yeah, I think thank you. And if nobody else has any questions, we will let you depart, and we're gonna go on with our in-person festivities.
All right, lovely. Thanks so much.
Thanks, Kaaren.
Bye-bye.
Bye.